In trading, it's extremely easy to analyze what's already happened and make sense of factual data. However, the true winners in the market are those who are able to accurately build hypotheses and predictions based off what we call technical analysis. So in today's video, we're going to discuss 3 easy patterns you can use to start identifying these trends in stock prices so that you can build a prediction on what's going to come next, make that trade, have your basis, and make money at the end of it. So before I even dive into what we're going to be discussing, I can't stress enough how important it is to understand support and resistance levels on a stock price. It's my belief that 50 to 60% of intelligent trading comes from understanding the different levels that a stock may go to, how it's going to behave at that point, meaning how strong or how weak is that support or resistance, and then using those levels for profit taking and for risk management by setting those prices as stop losses. Let's talk about 3 patterns that can help you trade better. Starting with the first, channels represent parallel lines within which a stock price may travel. This shows that there's a continued pattern and that there are 2 types of channels. Ascending channels show an upwards move, whereas descending channels show a bearish or downwards move in the price. Now you might be wondering, Harjit, what's it called if the price goes sideways? What that's called is trading in a range. So trading in a range essentially means that the price is unable to break above or below a certain price. So that kind of represents consolidation at that point. Buyers and sellers are reaching a point of equilibrium until there's enough momentum and enough movement to change the price, in which case we see the price move pretty quickly in whichever direction it breaks out. The second pattern we're going to discuss is called a wedge. So with these patterns, the support and the resistance line of the pattern, they start to converge, and just like channels, these also have 2 types. We have rising wedges and we have falling wedges. However, with these, the meaning of them are flipped. See, an easy way to understand wedges is to think of them as indicators of momentum. We use these shapes that look like wedges of cheese in correlation with volume to show that momentum may be dying out in that direction. So if it's a rising wedge, that's actually a bearish sign because it shows that the price is ready to fall, the momentum's starting to die out. It's like a roller coaster. The closer you get to the top, the more it starts to fall. And the same thing goes inversely for the falling wedge. It shows a lack of downwards momentum, shows that as you're getting to the bottom, as the stock price is starting to find a bit of a base, a bit of a support, we have a potentially bullish situation, which is where we have to start monitoring in accordance with volume. And lastly, we have triangles. These are phenomenal situations to be in because historically what I've seen is that they're very, very accurate and they show that pressure is building between a price. See, the bulls are struggling to get the price higher than a certain resistance, and the bears are trying to maintain that level. Think of it as being a wall. Right? You are pushing against it and you have to break through it. If you're not able to break through it, you lose your momentum and you can either go back the other way or you can come back with more force and try to break through. It's like running a marathon, except there are walls in your way that you have to break through. If you can keep breaking through these walls, it may slow you down a bit, but you're going to catch your momentum again and you can keep running. However, if the wall is too strong for you to break through, you can either turn around and go back the other way, or you can come back with more force to try and break through it. That's the same exact situation we see with triangles. When we have an ascending triangle, what we see is that there's a resistance line that the price is unable to break through, but the bulls are trying really, really hard. And if there's enough momentum with the bulls, they're able to break through that wall. And what we usually see in that situation is that the price moves very quickly and very rapidly and in a very accelerated fashion. And the same thing goes with descending triangles. It's the bulls at the bottom who are holding a support. The bears are unable to break through, and once they do, that's when we see the price start to move pretty rapidly. So these are 3 very easy patterns that you're going to find when it comes to charting. These aren't the only patterns, and they're not always 100% accurate. That's why part of trading comes from practice and understanding how the price of a stock moves within a certain range. If we see that there's a certain price that it has always historically struggled to break through, the chances are we're going to see it struggle once again. So you can use those as situations to say, hey, if it's unable to break through and it's going to fall, I can buy puts, or you can say, I'm going to wait for it to break through and then I'm going to buy calls. So you can use these situations even if it doesn't go your way, but being patient and following how the stock price moves in accordance with volume while simultaneously looking for these patterns will arm you to be a very strong trader so that you can start following facts and logic instead of feelings and emotion. So I just wanted to take a second and show some real life charting, because I know we've discussed these patterns, but I wanted to show something that's a little bit more realistic, So I wanted to take you through how I would go through and chart. So in this situation, I've pulled out DKNG, which is the ticker for DraftKings. For those of you who don't know, DraftKings is a online gambling platform. So they've worked a lot with like UFC and some of the other betting opportunities that exist. So what we're going to do is I'm going to start by switching over to my trend line. And I want to start by building patterns. So the first thing I see is if I go from here, I can build a bit of a trend line just like this. I'm going to set it up just like that. And then I can see that it's starting to find higher lows and lower highs. So this to me represents a bit of consolidation. And in this situation, we don't truly know right off the bat how things are going. But what I do see is this also looks a bit like a channel. So if I were to draw this right about here, what we can see is this is actually a descending channel. But then over here, this trend line just represents that the lows are getting higher, which is going back to that consolidation point. So this is a perfect example of the descending channel that we were mentioning. Now, if I were to go back in the history, I can extend this to 360 days. And that'll give me more access to the history of the stock price. Now, while I'm here, I may as well show you guys a couple things. What I did is I switched to my price tool, or my price level. This helps me chart basically bottoms of the stock, so I can find my support and resistance. So as I said earlier, I truly believe that 40 to 60% of intelligent trading comes from understanding your levels and understanding where your support and resistance is. So for example, this right here would be a support. Price was falling, found a base, continued up. Same thing here. Price was falling, found a base, and then continued up. So these are great tools that Thinkorswim provides. You have, and I'll be honest, these are the ones I use. I use the price level, which helps me create these flat lines. Then we have trend lines. Trend lines help us go in any which way or direction. And then there's also the Fibonacci. So I can use Fibonacci if I go to the 4 hour and I set it at a high of 74.38. And I bring this all the way down to 17.6. What that does is that creates these different levels for me for support and resistance levels. So if you're still struggling, you can definitely use Fibonacci to do that. But as you get better at trading, you're going to find that you may not actually need Fibonacci all the time. So with that, I just wanted to add a quick little lesson for us. If you have any questions, please feel free to reach out, shoot us a message on Instagram. But hopefully this was informational for you. With that, if I've misspoken at any point in this video, I do humbly apologize. Keep learning, keep loving, keep growing, and have a wonderful day.